Welcome to this episode of PhillipCapital's Market Watch. I am Darren Chan, Research Manager from Phillip Securities Research. In today's episode, I will be discussing our outlook on Singapore Real Estate Investment Trusts, or REITs for short, and which sub-sectors we prefer. The S-REITs index has performed well year to date, up 10.6% as of the filming of this video. This was partly supported by lower interest rates, with about 60% of S-REITs already seeing lower financing costs compared to a year ago. Interest rates have been trending down since late 2024, and we expect this trend to continue into 2026. Lower rates benefit S-REITs through reduced financing costs and cap rate compression, which lifts property valuations. Notably, the benchmark 3-month Singapore Overnight Rate Average, or SORA, has fallen 200 basis points year on year, equivalent to 8 Fed rate cuts. This decline especially benefits S-REITs with more Singapore dollar loans and less fixed rate debt. S-REITs are trading at a forward dividend yield of around 5.5%, which is one standard deviation below the 10-year historical mean of 6.1%, following the recent share price rally. Looking ahead, assuming share prices remain constant, we expect dividend yields to improve as absolute distribution per unit, or DPU, increases year on year, supported by lower financing costs and stable operating performance. To assess how much investors are being compensated for taking on additional risk by investing in S-REITs, we compare the S-REITs dividend yields with the 10-year Singapore government bond yield, a proxy to the risk-free rate. A difference is known as the dividend yield spread. As of filming, it currently stands at about 3.6%, or roughly 0.3 standard deviations below the historical mean. We expect the yield spread to widen as absolute DPU increases from lower financing costs and as the 10-year bond yield continues to decline further with interest rate cuts. A wider yield spread makes S-REITs a more attractive yield play. S-REITs are currently trading at a price-to-NAV of 0.99 times, which is about 0.1 standard deviations below the historical mean, even after the recent share price recovery. At these levels, we still see value, given strong DPU growth potential. With interest rates trending down, cap rates are likely to compress, leading to higher property valuations and higher NAV, which should, in turn, support share prices. Lastly, we move on to the subsector we favor the most, retail. In our view, the retail subsector offers the strongest potential for sustained high single-digit positive rental reversions, especially in suburban malls that focus on essential services and remain resilient during downturns. This is because occupancy costs, which is the rents tenants pay as a percentage of their sales, are still below historical averages, giving landlords room to increase rents. Coupled with limited new supply, steady retail sales, of which October 2025 retail sales index, excluding motor vehicles, rose 3.7% year on year, and a gradual recovery in international visitor arrivals that are still below pre-pandemic levels, retail fundamentals remain supportive of continued DPU growth. To conclude, with interest rates on a downtrend, we believe there is still room for S-REITs to continue their share price recovery, particularly given that DPU growth is expected for most S-REITs in the near to medium term. With that, I'd like to end this episode of PhillipCapital's Market Watch. Do remember to like this video, subscribe to us on YouTube, and follow us on our social media handles. Thank you for joining us, and see you soon.